Exercise 1. For the year ended December 31st, 2018, Fidelity Engineering reported pre-tax accounting income of $977,000. Selected information for 2018 from Fidelity's records follows. We've got interest income on municipal bonds of $32,000, depreciation claimed on the 2018 tax return in excess of depreciation on the income statement. So in other words, we deducted more in depreciation tax than we recorded on our income statement. Okay, $55,000. The carrying amount of depreciable assets in excess of their tax basis at year end was $85,000. Now that really doesn't help us because we don't know their original balance, and they've already told us what the depreciation difference was. So since we already have the depreciation, this is just added information that we really don't need for this problem. Warranty expense reported on the income statement was $26,000. However, actual warranty expenditures in 2018 was $16,000. Fidelity's income tax rate is 40%. At January 1st, Fidelity's records indicated balances of $0 and $12,000 as deferred tax asset and deferred tax liability accounts, respectively. Determine the amounts necessary to record income taxes for 2018 and prepare the appropriate journal entry. Well, first and foremost, when we're going about this, the two things that we find are the income tax expense, and I'm going to skip down a couple rows just to see, an income tax payable. In other words, the income tax expense is based on our accounting income. The income tax payable is what we actually have to pay to the federal government or the taxing authority, and that is actually based on taxable income. And the two do not always agree because of different things. Okay, so first and foremost, let's find what our income tax expense would be. In other words, we take that from the accounting income. So let's start there. So we've got accounting income on our income statement of $977,000. Now, in our information, it tells us there's interest on municipal bonds. That is not taxable, so we're going to go ahead and take that out in order to calculate our income tax on our income statement. And that brings us to $945,000 is our income on our financial statements, on our income statement. So that would be our income before tax on the income statement. We multiply that by our implicit rate of 40% there, and that brings us to a total of $378,000 in income taxes. So that's the expense we're going to report on our income statement, $378,000. Now, let's find the differences. Well, the first is going to be our depreciation. Now, in this case, depreciation is more on our taxes and less on our income statement. Eventually, that will reverse. In other words, we'll have more income tax expense on our income statement than we will have to pay in the future. What that creates is what we call a deferred tax liability. We're deferring recognition because we're actually deducting more now from our taxes than we will in the future. Okay, so I think I might have said that a little bit backwards just a second ago. Sometimes you get a little tongue-tied on these. But anyway, what that creates, rephrase, what that creates is a future taxable amount because we've deducted more on our taxes now than we will get to later. So they'll flip. Eventually, we'll end up having to pay more tax than what we report on our income statement. So we're deferring the payment of tax on this until the future. So that creates a deferred tax liability. And the total amount of that is going to be $55,000, the amount of the difference. And we're going to multiply that by the tax rate of 40%. And that tells me that my future taxable amount from this is going to be $22,000, or future taxable payable, the amount we're going to have to pay to the government. Okay, so that's the future tax payable. That'll be in the future. So for now, we're deferring recognition, so that's going to be a deferred tax liability. Okay. Now, deferred tax liabilities are liability accounts, so it's going to be a credit. So I'm going to go in here and I'm going to do deferred tax liability. I'm going to hit it for the 22. Now, we can either do these in whole, or we could actually put them in thousands. Just do 378 and 22. Either way is perfectly fine. All right, now the next thing that would create a difference is our warranties. We deducted $26,000 from our accounting income. We only get to deduct $16,000 from taxes. So as a result, on our warranty here, what we're going to have is a $10,000 difference. Multiply that by our rate of 40, and that's going to give us $4,000. Now, think about it this way. that creates what we call a future deductible amount, because we have 16 is all we're deducting now. Eventually we'll get to deduct the additional 10 as those warranty expenses come in. So eventually it's going to save us money on future taxes, and when that's the case, it's going to save us in the future. That creates what we call a deferred tax asset. So we're basically going to add to our deferred tax asset. Now we're recording them separately here so that we can see the different impacts. When we report them on the income statement, we would report them net. We're going to actually combine them. Deferred tax asset there. And that's going to be 4, because there's no point in showing a deferred tax asset of 4 and a deferred tax of 22. We could net those and just show the deferred tax liability net of 18. But we're going to report them here on our entry separately so you can see the impact of each of those events. Now that brings us to our income tax payable. How much do we have to pay? Well, that is $360,000. In other words, we're balancing out the entry here. Now we got that just by balancing the entry, but we could also prove it out. So the last thing we can do here is find our taxable income. Now notice we're going to start with the 945 because that excludes the municipal, so the 977 minus the 32 in municipal, same concept. Now on our taxes we got to deduct $55,000 more in depreciation, but we deduct $10,000 less in warranty expense. So that brings our taxable to $900,000. Multiply that by the 40% tax rate, and that gives us $360,000. That proves out that our taxes there balance out. So again, income tax expense, that's the amount we report on the income statement based on our accounting income. Income tax payable is based off our taxable income, what we actually should pay to the federal government or the taxing authority here. Okay. The difference between the two, the $18,000, creates a deferred tax asset or deferred tax liability depending on what we're dealing with. So we've got the $4,000 in asset here based on the warranty expense, and then the $22,000 based on the depreciation expense. Now the last question here says, what is Fidelity's 2018 net income? When we go in to find that, we would take our income, 977, minus our tax. Now wait a minute, why are we including the 32? Well, the 32 is still income, it's just not taxable income. So when we take that 977 minus the tax of 378 income tax expense, that's going to give us net income of $599,000. So that would be our net income. Again, if you wanted to remove all these zeros, you could to report this. Alright, so I hope that helps work another deferred tax asset, deferred tax liability problem.